Hey, what's going on, folks? Hope you guys are doing good today. In this video, we're going to talk about the micro crude oil contracts that are trading on the marketplace right now. So most recently, we have had the release of the MCL micro crude oil futures on the NYMEX, which is owned by the Chicago Mercantile Exchange. So what we're going to do in this video here is I'm going to give you a few cost comparisons and liquidity comparisons between various products. So if you enjoyed this content, don't forget to smash the like button and subscribe because it really helps with the YouTube algorithm. All right, so let's go. All right, so let me first explain what you're looking at on this screen right here. In the middle column, this is crude oil front month contract here, which is the CL. This is the contract that is currently the most liquid. As you can see, there's plenty of contracts at each bid and offer. This is the one that is being actively traded currently. In the middle of my screen now, and on the right side of my screen, I have some Interactive Brokers book traders, and they are displaying two different products. The reason I have them displayed on Interactive Brokers is because this is the only platform that I was able to display the data for you for these products. In the middle here, we have the MCL, the micro crude oil futures, which is also looking at the front month September contract. This is a new product. It was released July 12th, beginning of this week here. On the right side of my screen, I have the SMO, which is the small or micro US crude oil contract, which trades on the small exchange. This contract was released earlier in the year in May of 2021. So what you can see right off the bat is that there is a great difference in the liquidity at each price. On the left side, that's just a footprint of what's been going on here, 15-minute rotations. This is not important, but I just put it there to fill up the space on the screen. What we're gonna do now is talk about these products, compare them, and talk about a few things. First and foremost, I'm not an expert in any of this stuff, and none of this is gonna be trading advice, all right? You're looking at a guy wearing an Iron Maiden t-shirt telling you about trading, so please take everything I say with a grain of salt. I'm not a trading expert, but I do have some experience. So let's start by looking at the product specifications. Now, I'm not gonna give you every single specification of these contracts, but let's try and make it nice and simple. Normal CL ticker, for every tick it goes in your favor or against you, you're making or losing $10. So from 71.53 to 71.54, that's a $10 movement. So if I can get out with a successful one tick scalp right here, I will scalp one tick out of the market, and what's going to happen is I've profited $10 minus my commission, which is around $4 around turn, give or take. That's the average commission you'll pay. So a one tick scalp in the CL will still result in you being profitable by about $6 a contract. Now, these micro contracts, they're 10 times smaller than the CL, the one on the small exchange, as well as the new product released on the CME. Both have a $1 tick value, so they're 10 times smaller than the CL. So if I buy at 71.56 and sell at 71.57, theoretically I should be making a $1 profit, and then I need to subtract my commission cost from that. And that is the same for both of these products right here. Another thing is they're both financially settled. So this CL contract, I believe it's physical settlement. Both these micro crude oil contracts are financially settled. So if you trade these things, you don't need to worry about having physical delivery of oil. Anyways, brokers normally have specific rules regarding that anyway, so it's not really relevant to this video. All you need to know is that they're financially settled. So when your contract expires and you don't roll it, it's going to settle into cash. All right, so let's start by making some objective comparisons here to these two products. All right, so on my watch list, you can see I've got them both here. Now let's look at the amount of volume traded on the session so far here. So today it's July 16th, 2021. MCL front month contract has traded 17,000 contracts. $121 million in dollar value has been traded today. On SMO, the contract that has the same tick value, it's only traded 262 contracts today with a total dollar volume of 1.8 million. You can see right there, basically nobody's trading this contract right here. All right, so let's go on and look at the liquidity here. And what the liquidity is essentially the amount of contracts that are being provided at each bid and offer for people to trade. Now, what these actually are here, a lot of these orders are arbitrage market making orders. So there's various institutions that are employed by the exchange to essentially create a market for these products. I might not be 100% correct in every way that I explain it, but this is pretty much how it works. So their job is to provide the bid and the offer, and it's supposed to stay in line with what the value of crude oil is. Now, I don't exactly know how they manage their positions. Maybe if they get filled on an order, then they go and hedge themselves in the other market. That stuff is beyond me, but what you gotta know is that a lot of these orders here showing up on the order book are what they call arbitrage market making computer programs. So just by looking at these two order books, you can clearly see that there's a lot more liquidity here on the MCL versus the SMO on the small exchange. So on the SMO, if you look at it, you see these 10 lot bid and offers. Now I've spent some time watching this, and basically these 10 lot bid and offers are the arbitrage algos. Every other order you see, if you see a 2 lot, 1 lot, probably those are other orders trying to fill in the market. Let's talk about trading these two products from the perspective of a scalper, a trader who needs to enter and exit a trade very quickly. Generally speaking, you need to be trading in the market that's doing a lot of volume, so that way you can ensure you get in and out of a trade and not get trapped in a trade, right? So if there's not enough volume coming into your market, there's a high probability you're just going to get trapped in a trade. And there's also a high probability that your order might not fill at all. So this is what I mean. These 10 lot bid and offers here on SMO, these are arbitrage orders. So if I join the bid here at 61 and I join the bid where the arbitrage is, I'm not going to get filled by anybody there, because the job of the arbitrage is to provide the liquidity on the bid and offer. If I try to join the bid where the arbitrage orders are, they're not going to fill me. All right, I can't beat them at their own game. The only way my order here at 71.61 will fill is if some guy comes in and sells it at 71.61, and at that point the arbitrage orders are going to have queue priority over me anyways, so they're going to get filled before I get filled, which means that by the time I get filled, the market's going to be against me. You see what I'm saying here? For a market like this that's not trading a lot of volume, you can't successfully scalp it as an individual because there's not enough order flow to scalp through, right? So on CL, there's plenty of trades going through, and even CL is a little weird. You get the tape speeds up and slows down at random moments, and that's part of what the market does. There's a lot of volume flow in the S&P futures on average, so if you buy at one price and sell at another price very close, there's a high chance you're going to get filled on both those orders very quickly if the market's moving. In a market that's barely trading any contracts, you know, we got one contract there, one contract there, you're not going to get filled where you want to get filled, and you're not going to be able to beat the arbitrage algos at their own game. It's as simple as that. And this applies also to MCL, because this is still a relatively new product here, and of course there's going to be more people trading this because there's more liquidity to trade from. So, you know, generally speaking, if you were trying to scalp, meaning enter and exit a position in a short amount of time, you would most probably, almost surely want to be trading this contract, because there is less of a probability that you get trapped in a trade. These 10 lot bid and offers here, I wouldn't bet that they're going to fill you where you want to get filled. You can still try it, and that's going to bring us to the next issue here, is that what I've noticed, and it kind of ties into that other video I made about CME versus small exchange fighting for retail trader liquidity. It's that while the CME, and along with one of the biggest brokers in the US futures industry, which is AMP Futures, they're kind of like a mafia in the sense that they don't support the small exchange right now. Obviously, because they have a tighter relationship with the Chicago Mercantile Exchange, and they would prefer to support this product because they make more money supporting this product. I'm just sort of speculating when I'm talking about this stuff. It doesn't mean that it's true at all. It's just something that I think might be true. So that'll bring us now to the next point here, which is going to be the fee structure for these two products and how they differ considerably when it comes to their trading costs. All right, so let's go on and look at the trading costs for these products here. So on Interactive Brokers, I've done a couple of tests here, and to buy and sell on the MCL product, micro crude oil, the commission per side is 77 cents. With AMP Futures, which is the more popular day trading broker, the commission is about 69 cents. It might go as low as 67. I would consider this quite high, and I'll tell you why in a little bit. So actually right now what I'm going to do is I'm going to place a trade on the small exchange future, and I'm going to show you the difference in cost. Remember, both these contracts have the same tick value. So I just bought a contract there, and I'm going to sell one also. I just bought and sold a contract right there at the same price, and you can see the commission is 29 cents a side. That's about 60% or more less expensive than the commission for the micro crude oil contract. This is going to make a big difference for scalping. So these commissions here are the ones you're going to be paying if you use Interactive Brokers. It might be slightly different with another broker, but I'm going to tell you why these commissions matter a lot, especially if you're trying to enter and exit a lot of trades in a short amount of time. This is the way I see it. If your round turn commission costs more than a one tick movement in your market, then that is not a very ideal market to be scalping in, because that means that you need the market to move in order for you to even make money, and that's not very advantageous. All right, let's do the quick math here. We have 77 cents per side times 2, because we need to get in and out, $1.54. Let's just round it off to $1.50, okay? What this means that in order to get in and out of a trade in MCL, you're paying $1.54. Now, our tick value is $1, meaning from 71.74 to 71.75, you make or lose $1 in the market. But your round turn commission is $1.50, meaning that if you were to take a 1-tick scalp or a 1-tick scratch, you're still down money on the trade. And that's not very good. That means that in order to successfully be trading these micros, scalping, you need to be going for a lot larger moves, and you can't take 1-tick scratches. If you take a lot of 1-tick scratches, those commissions are slowly going to eat away at your account. Now, on the other side of the cookie here, we got the small exchange futures, 29 cents per side with Interactive Brokers. Let's round it off to 60 cents round turn. So if I buy the market at 64 and I sell it at 65, I actually made a 40-cent profit because my round turn commission is only 60 cents. So that's much, much better from a scalper's perspective. The only problem is not enough liquidity in this market to trade it successfully. So you guys can kind of see how I'm being really nitpicky here with these two products. So I personally find the commissions on MCL way too high, and the liquidity on SMO is not high enough. So which one are you going to trade? That's the question, right? I think we need to get the liquidity higher on the SMO. That would be the ideal situation to get people to start trading that more. Honestly, I don't know if that's even possible. Okay, so the next thing here, let's talk about margins. ampfutures.com margins. So I use AMP Futures for day trading. A lot of traders do, from what I've heard. And look at the day trade margin there, $100. So that means that you only need $100 to open a position in this contract, long or short. Now, to hold it after the close of the market, you need a much higher margin. That's called the maintenance margin. Because of course, holding into the close, there's a lot of gap risk, right? There could be news that comes out, so the brokers need to cover their asses there with a bigger margin. But as soon as the market opens again, it's back to a $100 margin. So that's AMP Futures. Now, Interactive Brokers is completely different. So let's look at the margins on Interactive Brokers here. So MCL, I'll just show you. We type in the ticker, futures. So look, that's our initial margin here. So Interactive Brokers does not offer day trade margins. So initial margin for the same exact contract, $644. So it's 6 times higher than the margin for AMP Futures. Let's go over and look at SMO now. The same contract, remember, the same tick value and everything, and lower commissions. Look at the margin for this one, $1,250. That's double the amount of the MCL. I don't know, guys. This is a little messed up from what I can see here. And, you know, I kind of understand them because on a product that has less liquidity, there is more risk to trade it, like I described to you earlier. That doesn't mean you got to put up double the margin. So my current quest is to try and find another broker that supports the small exchange products, that can offer intraday margins potentially for them, and that also supports the MCL and offers a more competitive commission than AMP Futures. The last part of what I just said, I don't know if that's going to be possible. So let's go over here and look at the CME's clearing and trading fees for the MCL. All right, so what we got right here is the NYMEX and COMEX fee schedule effective July 12, 2021 here. Look at the exchange fees right here. So micro WTI crude oil futures, 50 cents is the exchange fee, and if you're a member, it's 20 cents. Now AMP Futures, with everything included, the routing fee, the NFA fee, the broker fee, etc., you're paying 69 cents per side, as low as 67 from what I was able to understand. Now, meaning that CQG's routing fee is 10 cents. So CQG is making 10 cents every time someone trades one of these things. And then that extra 7 or 9 cents, that's the profit for the broker. So let's use a calculator to demonstrate that. Okay, so the exchange fee is 50 cents. And then with all the other fees, the total commission cost is 69 cents. It can go as low as 67. That's with AMP Futures, all right? What I know off the bat is that CQG's routing fee is 10 cents. We need another 9. So that 9 right there, that's approximately what the broker is making on the trade, unless they're making also a portion of the exchange fee. I don't know that. I'm anticipating that they don't make a portion of the exchange fee, but maybe they do, right? So let's anticipate that they only make 9 cents every time someone trades one of these things. I'm gonna automatically assume that other brokers will be charging even more to trade this product. So that's why definitely I'm gonna shop around and look at some quotes that other brokers are offering to trade this product. and we'll have to see if AMP is at the lowest or if some brokers are willing to go even lower. Again, with a 50-cent exchange fee, I don't think there's a lot of room for these brokers to bring it a lot lower there. Anyways, guys, so the point of this video was just to educate you guys about some of these products that have recently become available for trading. And what I would like to see is the liquidity to improve on the small exchange product. Honestly, if I could find a broker that offered reasonable margins to trade it and the liquidity improved itself, I would trade it. But in the current state, I don't think it's ready yet. Not enough volume. And also part of this video is potentially to stir up an interest. So guys, we'll check you out in the next video. Catch you soon. Bye.